Hello everyone, this is Sridharan from Wallet Wealth. So last week we have added a video on SIF and how SIF works and then whom it is suitable for. So based on that, there are a lot of questions that have come in. We are here to answer few of the questions that has been raised in the group. The first question is, why not I invest in normal flexi cap or large cap or a hybrid fund instead of this SIF? Primarily, the normal flexi cap, will invest only in the 100% of the money will be invested in flexi cap long term calls or large cap long term calls or hybrid funds long term calls. Wherein here they will take long term calls as well as they will take a short positions and derivatives and hedging is what actually they will be investing in. So here actually they will take 25% of the exposure in derivatives. 75% will be invested in the long term calls. That is how it is different from your mutual funds, normal mutual funds. The next question asked is, shorting sounds little risky. Yes, obviously, the shorting will be very risky if the market is actually going very bullish. So here in the SIF, they are taking only 25% exposure in derivatives. So that will be limiting your risk to the exposure of shorting. The next question asked is this like an AIF? Of course, this looks like an AIF, but there is a lot of difference between AIF and SIF. So in AIF, the minimum ticket size is 1 crore. And in AIF only, they will be able to take very complex calls, like complex derivative calls or other calls can be taken only through AIF, whereas mutual funds does not allow to take complex trading structure, wherein SIF they are allowed to take complex trading structure like derivatives or hedging can be taken to the extent of 25% of the underlying investments. That is the difference. And secondly, the AIF is having about 1 crore is the minimum investment size. Whereas here the minimum investment is considered to be 10 lakhs. And third is the liquidity. So when we are talking about liquidity, AIF has very limited liquidity, wherein here it is actually liquidity is immediate. Some of the funds are basically coming with an exit load, where if you exit before 1 year, you have to pay the exit load. But other than that, the liquidity is available to the investor. And finally, AIF, the investments, the underlying investments and other things, the accounting procedures are very complex in nature. Here it is more transparent and open in nature. So this is actually is the difference between AIF and SIF. So the SIF we can call it as the miniature of AIF because of the ticket size that they have is only 10 lakhs. The third is the fourth question they asked is this very high risk? Yes, of course it is a high risk investment. It is high risk rated band is on the 5 side. The risk rated is actually 5. So that means it is considered to be high risk, but it will provide you a better risk adjusted return because of this 25% exposure is there in the derivatives. And next is, what if the market crashes? So if the market crashes, normally when you are investing 100% in equity, it goes in line with the market. If the market crashes, your your NAV also will be crashes on the mutual funds. If it raises, it will also raises to the extent of the underlying portfolio where they have been invested here. But in the SIF, because of the short calls that is being taken by the fund manager, so whenever the market falls, your shorts will be providing you a positive return, wherein the long will be providing you the negative return. So the upside is basically is basically limited. The downside protection also is very, very high. So the downside protection is actually, is there in the SIF to some extent, or to the extent of the derivative exposure that they have. And the sixth question that they are asked is, why 10 lakhs is the minimum ticket size? So they need to differentiate this between the retail investors to sophisticated investors, because this is basically being a part of a tactical allocation in anybody's portfolio. The core portfolio, they should have at least some money in mutual fund investments. So the tactical portfolio, only the risk taking investors will be able to participate, and who understand the risk, who are basically a well informed investors, can only participate in the sophisticated structure like SIF. That is the reason why they have raised the bar to the limit of 10 lakhs. These are the questions raised by the group of investors, and I hope we answered all the queries. Thank you.